Alright, fail-safe investors. In today's video, we're going to talk about some common mistakes that people make when it comes to investing and some tips and tricks that help you along the way. And I know I look like I just rolled out of bed, but you got to work with me today. Matter of fact, just give me 1 second. Alright, let's get back to business. So first off, I want to say one mistake that I notice a lot is over diversification. So a lot of people will like send me photos of their portfolios or ask me to look into companies for them, and it's like they're literally just picking companies at a whim. Like you could literally just have a board full of companies or stocks, throw a dart at it, and have better luck than some of these portfolios I'm seeing. So don't follow a trend. Like when you're picking a company, you want to do the research so that you know that this company is a good buy. So unless you're investing millions of dollars, you don't need 10, 20 companies in your portfolio. I'll say if you're investing like less than $1,000 regularly, you pretty much just want to have like 3 to 4 companies that you know are just going to kill it for you. And then understand what type of stocks that you're getting into. So you have 2 types of stocks that people generally talk about, which is called value stocks, which are like your Coca-Cola, Apple, or Microsoft, like companies that's been around for a long time and that you know is going to be around for a long time. But the downside with value stocks is the growth potential. These companies don't generally grow rapidly. It's like slow growth. They will grow, but it's slowly. And then you have growth stocks, which are the companies that you invest in that have like medium to small market caps, so they have room to grow. So that depends on what type of investment you're looking for, short-term or long-term. Long-term will be your value stocks, short-terms will be your growth stocks. So understanding that will help you out a lot. Okay, so I know I'm gonna sound like I'm contradicting myself, but another mistake that I'm seeing is some people not diversifying their portfolio enough. So I'm seeing like a lot of people want to get into the travel industry, so they'll invest in Carnival Cruise, Norwegian Cruise, and Royal Caribbean Cruise, and they'll have all of those in their portfolio. And that's pretty simple to understand. It's like, in this case, if you're watching a sporting event, or let's say a basketball game, are you going to bet on both teams that are playing each other? So you want to invest in one company in each sector, or generally not more than 2 companies. So if you're investing in the tech companies, you don't want too many companies in the tech sector. And the same thing for every sector that you want to invest in. Like me personally, I only have 3 stocks in my portfolio, and I'm not in the tech sector at all, but I'm in 3 different sectors: industrials, financials, and consumer products. That's just me. So you don't want to have too many stocks in one sector, because what if Carnival sells for like $5 a share and goes up to $10 a share? And then you have Norwegian or Carnival selling at $10 a share and goes down to $5 a share, and you have an equal amount of both. You're not winning at all, you see. So it's like you have to diversify your portfolio in different sectors. And I can't say this enough: if you do not feel like doing this individually, just invest in an index fund and let it happen, and just follow the stock market as a whole. And this is probably the biggest mistake that I noticed that everyone is making: understanding the company that you're investing in. So a great way to understand the company that you're investing in is to print off the 10K. You have to print off the 10K. I've been saying this forever: balance sheet, balance sheet, balance sheet, because it matters. You have to see how much cash the company has on hand, how much total assets, how much liabilities, weigh the assets against the liabilities. You have to print this off. In the 10K, it will literally show you everything about the company. It even lists risk factors with the company. Like I printed this off, Delta's 10K, and this is from 2019, but it was, I think, filed in January 2020, and it literally mentions COVID-19 in here. So you have to print off the 10K and understand the company that you're buying, because if you don't understand the company that you're buying, then how do you know if you're overpaying for the company? It is as simple as that. So you have to know how the company operates, how they make money, revenue, all of that, to know if you're getting this company for a good price. Because like I've said before, the price on the chart does not represent the actual value of a company. So don't look at a company's chart and think, oh, it will get back up there. You don't really know that. You have to see how these companies make money. What are their investments? What are their future plans? All of that is in the 10K, and you can listen to earnings reports and all of that. And that's why I also say you probably don't want to invest in too many companies, because sometimes people don't want to do the research on all of these companies, which is why I only have 3 companies in my portfolio. That I only have to keep up with 3 companies, I can live my life. Another mistake I see people make is trying to time the market. You don't know what a bottom is. Remember what they say, hindsight is 20/20. So you won't know the bottom until it's already going up. A tip would be using a strategy called dollar cost averaging. And I use it myself, and pretty much what dollar cost averaging is, you set aside a certain amount out of every check, every week, every 2 weeks, every month, however you want to do it. Do not overspend, do not go into debt trying to invest. But you set aside a certain amount, and what you do is you pick every 2 weeks or a month, whatever, and you invest however much that money can get you in shares in that company whenever you choose to. And that way, when it's going down, you can catch it at its lows, and when it's going up, you can ride it up all the way. And that helps, because it also takes out the pressure of having to watch the market and trying to time it. Another tip would be, like I've said before, read the balance sheet, read the 10K, and that will give you confidence in these companies. But if you're assuming that this company is hiding something from you, if you can't find what they're hiding from you, then just assume that they're being honest with you, because they have to file that with the SEC, which is a government entity. It's like you filing your taxes. Yes, you can try to hide things on your taxes, but you still have to put it in your taxes. You can say, oh, I spent $1,000 on my house to get a tax credit, but you still have to say that I earned $1,000 and I spent it this way. So it's just whatever you want to do. Like I said, if you don't have the time to do the research on the company, and you don't feel like reading through 10Ks, looking at balance sheets, and fully analyzing the company, put your money in an index fund, and that way you don't have to continuously look at it every single day. That way, if you have your money in an index fund, if the market does well, then you do well. Your money go up if the market goes up, your money goes down if the market goes down. But you have to have confidence in the market, or whatever you choose, to ride it through the ups and downs. So that's how investing works. Like, if you have to have the confidence in a company that you're investing in to know that even if it goes down, that it might go back up, but you have to know, like, this is your company pretty much. You have to ride out the storm. If you was working at that company, would you bail out when things get bad? Probably not. So it's the same thing with an investment. You have to look at it like that. Like, if this company does bad, I'm still with it. So you have to look into these companies. But my biggest tip would be to educate yourself. If you don't know something, there's videos. I have videos. There are other people on YouTube that have videos. The information on Google. Just figure out the lingo, how to invest, and strategies. You can Google index funds. All of this, how to diversify your portfolio, which I have a video on myself, and I'll leave the link in the description below. But just educate yourself. Right now, you've been given the gift of time. I'm pretty sure, like most people have at this time. Use it. Educate yourself. Make some fail-safe investments. And my last words is good luck. Let's get it. Let's do it.